I was scanning the overnight risk reports when the red alert flashed across my terminal, indicating something so catastrophic that I initially assumed it was a system malfunction or perhaps a cyber attack designed to create false panic in global financial markets. Tuesday, December 17th, 2025, 6:12 a.m. Eastern Time. The moment I discovered that Crédit Suisse, one of Switzerland's oldest and most prestigious banking institutions with over 165 years of operational history, had been declared insolvent by Swiss financial regulators following catastrophic losses on silver derivatives that exceeded their entire Tier 1 capital reserves by a margin so vast that recovery was mathematically impossible regardless of future market conditions. The liquidation wasn't a controlled wind-down or strategic restructuring designed to preserve shareholder value while protecting depositors and creditors through careful asset management and negotiated settlements with counterparties. This was an emergency seizure by banking regulators who had discovered during overnight examinations that Crédit Suisse's silver derivatives exposure was so massive and so poorly hedged that continuing operations posed immediate systemic risks to the entire Swiss banking system and potentially the broader European financial markets that relied on Swiss banking stability for international commerce, wealth management operations, and cross-border financing arrangements that processed trillions of dollars annually. The scale of their exposure was breathtaking in its recklessness and sophistication. $47 billion in notional value across multiple derivative instruments, structured products, and off-balance sheet entities that had been designed to generate steady income while appearing to limit risk through mathematical hedging relationships that proved worthless when silver markets stopped behaving according to historical patterns that financial engineers had assumed would continue indefinitely. $47 billion. That was the notional value of Crédit Suisse's silver derivatives book when regulators froze the bank's operations at 3:30 AM Zurich time after discovering that their mark-to-market losses had exceeded their regulatory capital buffers and their liquid asset reserves were insufficient to meet margin calls that were accelerating exponentially as silver prices continued their relentless climb toward levels that their mathematical models had indicated were virtually impossible under normal market conditions. The bank's derivatives exposure consisted of multiple layers of increasingly complex financial instruments that had been designed to generate steady profits from silver price volatility while theoretically limiting their downside risk through sophisticated hedging relationships that had proven reliable during decades of relatively stable precious metals markets. But the recent silver price explosion had invalidated every assumption underlying their risk management framework and transformed their profit-generating strategies into wealth destruction mechanisms that were operating with devastating efficiency. At the foundation of their derivatives book were approximately 280 million ounces of outright short silver futures contracts that they had accumulated systematically over 18 months as part of their comprehensive precious metals manipulation strategy that generated consistent profits by exploiting predictable patterns in retail investor behavior and industrial procurement cycles. These positions had been enormously profitable when silver traded in carefully managed ranges between 18.35 per ounce, allowing the bank to sell high during artificial rallies they helped create and cover low during coordinated selling campaigns that broke bullish momentum and forced liquidation among speculative traders. The futures positions were complemented by an intricate web of over-the-counter swap agreements with mining companies, technology manufacturers, aerospace contractors, and sovereign wealth funds that wanted protection against silver price movements that could disrupt their budgets or strategic planning. Crédit Suisse had enthusiastically sold price insurance to these clients, collecting substantial premiums estimated at over $400 million annually in exchange for contractual promises to pay the difference if silver prices moved beyond predetermined ranges that their sophisticated quantitative analysis suggested were extremely unlikely to be breached under normal market conditions. The most dangerous and lucrative component of their derivatives exposure was their structured product operations, where they had created and aggressively marketed billions of dollars worth of investment products to wealthy private clients, family offices, and institutional investors who wanted leveraged exposure to precious metals performance without the complexity of direct commodity trading. These products promised investors enhanced participation in silver price appreciation while guaranteeing protection against major losses through complex option strategies and mathematical hedging relationships that required the bank to maintain massive offsetting positions in futures markets and physical silver inventory management. But the Swiss banking giant had constructed this derivatives empire on fundamentally flawed assumptions about silver market behavior that seemed reasonable based on historical precedent, but proved catastrophically wrong when industrial demand patterns shifted beyond their analytical framework. Their risk models assumed that silver would continue behaving like a traditional financial commodity subject to normal supply and demand cycles, predictable seasonal patterns, and psychological trading dynamics that sophisticated institutions could exploit through coordinated market manipulation strategies. When silver began its explosive rally in early December 2025, Credit Suisse's derivatives book initially appeared manageable despite mounting losses on their short positions. Their risk management systems indicated that their hedging strategies would limit their maximum loss exposure to approximately 2.3 billion, even in extreme scenarios that included silver prices reaching $75–80 per ounce, levels that their quantitative analysts considered statistically impossible based on historical volatility patterns and supply-demand modeling. But the Swiss bank had made the same fundamental error that had destroyed other major financial institutions. They had assumed that silver would continue behaving like a traditional commodity subject to normal market forces, rather than recognizing that it was transforming into a strategic industrial material whose scarcity value could overwhelm traditional pricing mechanisms when industrial buyers began competing aggressively for limited supplies. The cascade began on Monday, December 16th, when the Shanghai silver premium expanded beyond $8 per ounce relative to New York prices, indicating that Chinese industrial buyers were willing to pay massive premiums for immediate physical delivery, while Western paper markets remained disconnected from physical reality. Credit Suisse's derivatives book was structured around the assumption that global silver markets would remain integrated, making sustained regional price differences impossible to maintain through normal arbitrage mechanisms. The Shanghai premium invalidated their hedging relationships and created margin calls on positions that were supposed to be automatically hedged against major price movements. As silver prices climbed from $68 to $72 during Monday's trading session, their derivatives losses accelerated exponentially, while their hedging positions failed to provide the protection their mathematical models had promised. Tuesday morning brought the acceleration phase as news emerged that three major Chinese technology conglomerates had signed exclusive 10-year supply agreements with South American mining companies, effectively removing approximately 85 million ounces annually from global trading markets and redirecting them toward Chinese manufacturing operations that viewed silver as an essential production input rather than a speculative investment opportunity. The supply agreements represented more than commercial contracts. They were evidence that Chinese industrial planning was systematically securing strategic materials through direct relationships with mining operations that bypassed Western financial markets entirely. If Chinese buyers could lock up mining production through long-term contracts at negotiated prices, traditional commodity trading mechanisms would become increasingly irrelevant to actual supply allocation decisions. Credit Suisse's derivatives book was designed around the assumption that they could influence silver prices through coordinated paper market operations and that physical supply would remain available through normal commercial channels. But the Chinese procurement strategy was making both assumptions obsolete by removing physical silver from markets while demonstrating that industrial buyers possessed sufficient capital and strategic planning capabilities to overwhelm financial market manipulation attempts. The technical breakdown began at 11:47 AM Zurich time when automated risk management systems detected that Credit Suisse's silver derivatives book had breached multiple loss limits simultaneously. Their value at risk models indicated maximum potential losses exceeding $8 billion under stress scenarios, while their actual mark-to-market losses were approaching $12 billion and accelerating as silver prices continued climbing towards $75 per ounce. The bank's liquidity position deteriorated rapidly as margin calls on their short futures positions required immediate cash deposits to maintain their trading accounts with commodity exchanges. Simultaneously, their structured product obligations were generating cash outflows as investor protections triggered automatic hedging requirements that forced the bank to purchase silver at increasingly expensive prices to fulfill their contractual obligations to private clients. Swiss banking regulators had been monitoring Credit Suisse's precious metals exposure since the November silver rally began, but their supervisory assessments had relied on the bank's own risk, reporting that consistently understated their potential losses through mathematical models that assumed normal market correlations and volatility patterns. The regulators discovered too late that the bank's internal models were fundamentally flawed, and their actual exposure was multiples of what they had reported. The emergency examination that began at 2:15 a.m. revealed that Credit Suisse had concealed the true extent of their silver derivatives exposure through off-balance sheet vehicles, subsidiary operations, and complex structured transactions that distributed their risk across multiple legal entities while maintaining economic exposure that concentrated their losses in the parent bank when adverse price movements occurred simultaneously across all their related positions. The most damaging discovery was that the bank had been selling price protection to clients while simultaneously maintaining massive short positions that created conflicts of interest and concentrated risk rather than diversifying it. When silver prices rose, they lost money on both their proprietary short positions and their client protection obligations, creating a double exposure that their published risk metrics had failed to capture accurately. Swiss regulators faced an impossible choice as dawn broke over Zurich: allow Crédit Suisse to continue operating while hoping that silver prices would decline enough to restore their solvency, or seize control of the institution immediately to prevent their silver derivatives losses from expanding beyond levels that could threaten the stability of the entire Swiss banking system. The decision was made at 3:30 a.m. when silver prices opened in Asian markets at 76.80, indicating that the Monday rally was accelerating rather than exhausting itself through normal profit-taking activities. Credit Suisse's mark-to-market losses exceeded $15 billion at the Asian opening price, representing more than 140% of their Tier 1 capital and making their insolvency mathematically certain regardless of subsequent price movements. The Swiss Financial Market Supervisory Authority issued emergency declarations placing Credit Suisse under regulatory control while freezing all derivatives trading activities and suspending normal banking operations that could increase their exposure to additional losses. The bank's shareholders were effectively wiped out. Their bondholders faced substantial losses, and their employees discovered that their careers at one of Switzerland's most prestigious financial institutions had ended overnight due to silver derivatives that few of them understood or had any control over. The immediate market impact was devastating as global financial markets recognized that if Credit Suisse could be destroyed by precious metals derivatives, similar exposures at other major banks could create a cascade of institutional failures. Bank stocks plummeted across European and American markets as investors attempted to identify which institutions might have similar hidden exposure to silver derivatives that could threaten their solvency if precious metals prices continued rising. The systemic implications extended beyond immediate market volatility to fundamental questions about the stability of the global banking system in an era when commodity markets were no longer behaving according to historical patterns that financial institutions had relied upon for decades of profitable trading operations. Credit Suisse's failure demonstrated that even sophisticated European banks, with centuries of experience and billions in capital, could be destroyed within days by positions they had considered routine and low risk. The Federal Reserve, European Central Bank, and Bank of England convened emergency meetings to assess whether Credit Suisse's failure represented an isolated incident or evidence of broader vulnerabilities in the global banking system's precious metals exposure. Regulatory authorities began demanding detailed reports from all major financial institutions regarding their commodity derivatives exposure, particularly positions related to silver and other strategic materials that were experiencing similar industrial demand pressures. The investigation revealed that Credit Suisse wasn't alone in their massive silver derivatives exposure. Deutsche Bank, BNP Paribas, and HSBC had all built substantial short positions in silver markets, while selling price protection to clients who wanted hedging against precious metals volatility. The cumulative exposure across European banking institutions exceeded $180 billion in notional value, creating systemic risks that regulators hadn't recognized because they had treated precious metals as stable, predictable commodity markets rather than strategic materials subject to industrial demand shocks. The Chinese response to Credit Suisse's failure was measured and strategic, with official statements indicating that their industrial silver procurement programs represented legitimate commercial activities designed to support domestic manufacturing rather than speculative attacks on Western financial institutions. Chinese officials noted that their companies were simply securing materials needed for solar panel production, electronics manufacturing, and battery technology development that served both domestic economic development and international export markets. But the timing of additional Chinese procurement announcements immediately following Credit Suisse's collapse suggested coordinated strategy designed to maximize pressure on Western financial institutions while securing advantageous supply agreements with mining companies eager to diversify away from customers who might face similar regulatory seizures. Chinese buyers increased their forward purchasing commitments by approximately 40 million ounces within hours of the Swiss bank's failure, demonstrating that they viewed Western financial instability as an opportunity to accelerate their strategic material accumulation programs. The silver market's reaction was immediate and brutal for remaining short sellers. Prices gapped higher by $4.20 at the Asian market opening as algorithmic trading systems interpreted Credit Suisse's failure as confirmation that institutional short covering would accelerate across the banking sector. The gap created additional margin calls for other banks with silver derivatives exposure, forcing emergency covering operations that pushed prices even higher and created self-reinforcing cycles of institutional buying pressure. By the European market opening, silver had reached $82.15 per ounce, representing a gain of over $7 in less than 24 hours, driven primarily by forced institutional covering rather than fundamental industrial demand or retail investment buying. The price action resembled classic short squeeze dynamics where institutional selling pressure reverses into institutional buying pressure, creating explosive price movements that overwhelm normal supply and demand considerations. The human cost of Crédit Suisse's failure extended beyond shareholder losses and regulatory seizure to the immediate unemployment of approximately 48,000 employees worldwide, whose careers were ended by derivatives trading decisions made by senior executives who had prioritized short-term profits over institutional survival. The bank's wealth management clients faced account freezes and uncertain access to their assets, while regulators attempted to separate healthy business operations from the derivatives trading activities that had destroyed the institution. Swiss political leaders faced intense pressure to explain how their banking regulators had failed to detect or prevent the derivatives exposure that destroyed one of the nation's most important financial institutions. The failure threatened Switzerland's reputation as a stable haven for international wealth management and raised questions about the competence of Swiss financial supervision in an era when commodity markets were becoming increasingly complex and interconnected with broader economic systems. The broader implications for precious metals markets were profound and permanent. Crédit Suisse's liquidation removed one of the largest and most sophisticated precious metals manipulation operations from global markets, eliminating billions of dollars worth of artificial selling pressure that had suppressed silver prices for years. Without the Swiss bank's coordinated short-selling campaigns, silver prices would be determined increasingly by actual industrial supply and demand rather than financial market manipulation strategies. The failure also demonstrated to other major banks that precious metals derivatives exposure carried existential risks that their traditional risk management frameworks were inadequate to measure or control. The mathematical models that had indicated Crédit Suisse's silver positions were safe had proven completely unreliable when confronted with industrial buyers whose strategic imperatives made them immune to the psychological manipulation tactics that traditional precious metals trading relied upon for profitability. Credit rating agencies began systematic reviews of major bank precious metals exposure as they recognized that the commodity trading operations that had been considered stable profit centers for decades might represent unrecognized threats to institutional solvency. The rating downgrades that followed affected bank funding costs and lending capabilities, creating broader economic impacts that extended far beyond the commodity trading desks that had created the original risks. The regulatory response was swift and comprehensive, as authorities recognized that precious metals derivatives had created systemic risks that traditional banking supervision hadn't adequately addressed. New capital requirements were imposed specifically for commodity derivatives exposure, while enhanced reporting standards demanded real-time disclosure of precious metals positions that could threaten institutional stability during periods of extreme price volatility. But the most significant long-term impact was the demonstration that industrial commodity demand could overwhelm even the largest and most sophisticated financial institutions when applied with sufficient scale and strategic coordination. Chinese buyers had proven that they possessed the financial resources and planning capabilities to neutralize Western financial market control over strategic materials, pricing through systematic procurement strategies that bypassed traditional commodity trading mechanisms. The evening news coverage focused on the immediate drama of Switzerland's banking crisis and the human interest stories of displaced employees and frozen client accounts. But the real story was more fundamental and alarming. The failure of Crédit Suisse represented the first major casualty in a broader transformation of global commodity markets, where industrial necessity was beginning to override financial market manipulation as the primary determinant of strategic material prices. As markets prepared for Wednesday trading, silver remained above $82 per ounce, despite normal profit-taking pressure that should have contained such rapid price appreciation. The absence of Crédit Suisse's systematic selling pressure had fundamentally altered market dynamics, while the threat of additional bank failures created reluctance among remaining short sellers to maintain aggressive positions that might trigger similar regulatory intervention if precious metals prices continued rising. The Swiss bank's liquidation had proven that the era of risk-free precious metals manipulation was permanently ended. Financial institutions could no longer assume that they could control commodity markets through coordinated paper trading strategies without facing existential risks, if industrial buyers decided to challenge their artificial pricing mechanisms through sustained purchasing campaigns backed by unlimited capital resources. Credit Suisse's failure would be remembered as the moment when the global financial system discovered that precious metals had evolved from speculative trading instruments into strategic industrial materials, whose scarcity value could destroy even the most sophisticated banking institutions if they positioned incorrectly during periods of fundamental market transformation. The bank that had survived centuries of financial upheaval had been eliminated in 3 days by silver derivatives, proving that the new rules governing commodity markets were far more dangerous than anyone had imagined. The liquidation marked the beginning of a new era where banks would approach precious metals trading with the extreme caution traditionally reserved for the most dangerous and unpredictable financial instruments, while industrial buyers would continue systematically expanding their direct procurement strategies to secure strategic materials without interference from financial market manipulation schemes that had historically distorted commodity pricing mechanisms for decades. The silver spike had claimed its first major institutional victim in spectacular fashion, but the broader transformation of global commodity markets was just beginning as other strategic materials including lithium, cobalt, rare earth elements, and copper faced similar industrial demand pressures that could potentially threaten additional financial institutions unprepared for the new realities of resource scarcity in an advanced industrial economy increasingly dependent on sophisticated technologies requiring massive material inputs that traditional mining and supply chain systems couldn't adequately provision at the scale and speed demanded by accelerating technological transformation.